Let's battle it out in our bull versus bear segment for the week with the spotlight on Peloton. Shares of PTON hitting a new 52-week intraday low. This as we're continuing to see a broader move lower in the stock and the shares. New Construct CEO David Traynor thinks the stock could decline to $0. And Needham and Company Managing Director Bernie McTernan, who maintains his buy rating, join us now to make their cases. All right, so David, the bear, Bernie, the bull. First, Bernie, I got to talk to you as we kind of kick things off here on the day. As I'm looking through some of the new news that has come out, Peloton going to be partnering with Dick's Sporting Goods. This gives them kind of a physical IRL partnership to add on to what they had already done with Amazon for the e-commerce partnership. Does this make a difference?
Yeah, I mean, we'll see. It's, as you mentioned, it is part of their strategy to get into more third-party distribution. And that's what the company's trying to do, where they've taken the DTC strategy as far as it can go, at least at this point, especially where end markets are. So some things to reaccelerate growth, this third-party channels. We have fitness as a service, certified pre-owned, the push of the digital app, and even more equipments like the rower that should be coming out shortly. So Peloton's clearly in a difficult position. That's a well-known, and really Barry McCarthy has come in and trying to really test and really see what sticks and if there is anything to do to accelerate growth here. Because I know for us, we barely have any subscriber growth at this point, going over the next 10 years. So for us, even though that risk reward is really wide, especially when you're dealing with revenue multiples, like a day like this, there's not really a floor to the downside. That's the upside risk if they can figure out what to reaccelerate growth while waiting for that market to return.
Well, David, some of the question marks around that growth actually play right into your bear case, particularly, and you've also taken it one step further, talking about the products, which are now going to extend even into the new rower as well. They've got the Peloton Guide, of course, the trademark Bike Plus, and the Tread. With all of that in mind, you've said that the product is undifferentiated and too expensive. So even if they do have these new partnerships on the commerce front, how do they eventually start to get into new homes or just get more subscribers? It sounds like, though, you believe that this stock just going to zero, they're not going to be able to do that.
You got to start with the unit economics. First, they have to produce a product that actually generates a profit, and they're not doing that. So whether or not they sell that over their website, Amazon's website, or in Dick's Sporting Goods stores, sort of doesn't matter how much you sell a product that doesn't actually generate a profit. And when I say undifferentiated, I mean, as far as I know, their treadmill isn't a magical treadmill that's that different from other treadmills. Their stationary bike is not that different from other stationary bikes. Their content is not that much better than other sources of content for workouts. Look, we're talking about a workout product. We're not talking about some new workforce automation technology or robots, right? It's workout products, and it's priced as if it's going to continually grow and achieve much better margins than it's ever achieved. And we just don't see we don't see a path to that at this point in time. Meanwhile, the last 12 months, it's burned $2.8 billion in cash. I think they only have around maybe $1 billion of cash left on the balance sheet. So look, you can do the math. They can't survive much longer without drastically changing the business model or getting new financing, which in the current environment is going to be very difficult.
Bernie, do you believe that there is a different business model that Peloton could take on? I mean, they had gotten into the market, not just on the connected device front, but also under this lure for so many fitness enthusiasts that they could access what would otherwise be a boutique fitness experience with more technology from the comfort of their own home.
Yeah, and I guess I would push back on that. I do think that the content is differentiated. We've done a bunch of different screens, especially like when Apple Fitness Plus came out, for example. Peloton's putting out dozens of pieces of content per week, while Apple was doing that, on a monthly or bi-monthly basis. What that means is that there's just more choice, meaning you can choose your instructor, you can choose the music, the level of difficulty. It's really that breadth and depth of content that we think is a big differentiator for Peloton. And that's why we're focused on that subscription revenue that's over $1 billion now, heading towards $2 billion over time. And it's 70% gross margin. So certainly the products gross margin margins is negative right now. We don't have that reaching back to positive territory for a couple of years. And even then, we only have been getting back to 20% gross margins versus the highs in the 40s. So again, it honestly comes down to expectations, and we just don't see much, being priced in at the stock at these levels for growth or giving the company credit for the $800 million of cost cutting that Barry McCarthy thinks that they're going to do. So we have them getting back to EBITDA profitability in fiscal 24, and don't see them, running out of cash. But I think that the recent price increase they did was important, and mainly because the churn dynamics weren't as bad as bears feared, which shows that Peloton does have pricing power. And I think there is a element of affordability when you talk about $44 per month for the household versus if you go to a SoulCycle class, it might be $40 per class. Mm-hmm. So I think that there is a savings there for especially the high using Peloton subscribers.
Hey, David, want to give you one more opportunity to jump into the conversation here, especially with regard to the amount of cash that Peloton would need. Let's say hypothetically that the churn were to stabilize and perhaps some of the growth would actually be re-energized there among the subscriber base. Then what? How much cash, even with the $800 million in cost savings that they're trying to implement, would they need to raise on the cash front in order to not just weather the near term, but to also kind of sustain some of their margin growth and just some of the revenue growth as well?
Yeah, no, they're absolutely going to need more cash. I mean, they're burning at an alarming clip. And look, the bottom line on content is that it's expensive to produce. I mean, just look at the troubles that Netflix has had, right? People don't realize that Netflix is a terribly cash flow negative business because they capitalize all those content costs. Yeah. Content is not cheap. Good original content is expensive. So that's not going to save the business. And you got to keep in mind that margins right now, profit margins are negative 30%. And in our model, when we assume an improvement of that profit margin from negative 30% to almost 2%, and then growing revenue at 24% compounded annually for the next 8 years, that implies a stock price of around $6. Yeah. Right. So if you want to talk about what's priced in, there's a lot of really good stuff already priced in.
David, we got to go very quickly. Do you believe that Peloton gets sold?
I don't know who would buy them, right? I mean, do you think anyone who's using Peloton doesn't already have an Amazon subscription or buys Nike stuff? I don't really know where the value add is. I mean, we're talking about exercise equipment with, connected to the internet or to a computer screen. I mean, I don't see the value add for anyone to buy a Peloton. No. All
right. And Bernie, just very quickly, also got to go here. You've got about a $14 price target as of right now, given the declines we're seeing today. Any updates, any kind of changes in that guidance?
No estimate. That's changes or price target changes to talk of right now.
All right. New Construct CEO David Traynor and Needham & Company Managing Director Bernie McTernan, thanks so much for joining us here today.